Hello, welcome everyone to the Options Hour on TFNN. My name is Victor Jones, filling in for Don Kaufman. We've got a very interesting hour for you. Obviously, we've got a lot to talk about. At a low of 1068 right here on the open to trading up to about 1094 in the S&P 500. We've got a lot of move, we've got a lot of volatility, and therefore a lot of opportunity. So over the next hour, we're going to take as many of your questions as we can out there. If you want to go ahead and give us a call at 877-927-6648, we're going to be answering anything on, futures options, stock options, overall market, even technology if those questions are out there. So I would encourage you to give us a call for the next hour. We're going to be taking your questions and talking, obviously, options. Again, 877-927-6648. Again, as I mentioned, just to give a quick update on where we are in the market today, a low of 1068 right around 9 o'clock, as you can see on the chart if you're tuning in over the webcast, and 1068 being to a 30-point move almost here to the upside at 1095 and a quarter. I mean, it's quite a move. If we're looking at what we're actually seeing at the same time with what the VIX has done over this morning, we saw $46.88 on the upside this morning. So clearly a very, very high number in terms of the VIX. We've moved off to about $43, which is around where we've been over the last week or so. I mean, probably 42 is the number we've really been hanging around over the last 3 or 4 days. But again, a move up to 46.88. And for some of you looking for opportunities this morning, either to sell options or looking at taking advantage of that increased volatility, definitely that opportunity presented itself this morning. Heading back again into the S&P 500. And when I'm quoting this, we're looking at the E-mini S&P 500 futures contract. So currently the DEES contract, December, is the active month, and we're trading again 1094.75. We're up about $8.50 on the day. So, what was interesting about a day like today when you have increased volatility and a VIX move up to 47 is, where was the opportunity? What else out there, relatively speaking, has high implied volatility? And I'm kind of a market junkie. I'm kind of an implied volatility junkie, obviously. And so over this next hour on Options Hour TFNN, give us a call, 877-927-6648. What we want to talk about is, what we did about 2 weeks ago when we were going into, Operation Twist with the Fed meeting when I was on last time. We kind of looked at what effect that was going to have on the overall market. And that next day it was pretty ugly, in terms of the bond. So if we take a look back at what's happened over the last 2 weeks since we last talked, obviously the Fed said, they were going to sell about $400 billion in short-term treasuries in order to buy some of the longer-term ones. So if you were looking at TBT at that time, which we talked about, and obviously that meeting having, a very big impact on yields, especially the longer-term yields, and TBT being a 20-year Treasury or ETF that tracks the 20-year Treasury, it was a pretty ugly move. We were already at new lows on TBT, but we've got a few callers here. We're going to get to them, but again, keep in mind what we've seen here with the Fed, and still some questions out there. I mean, Ben Bernanke came on today, and he was talking a little bit about what we might plan to do or what the Fed's looking to do in terms of stimulation going forward. So I think we've got a couple calls here. We've got Steve on our call list, number one. We'll go ahead and take a call from Steve.
Hello.
Hi, Steve.
Hi. I've got a question in regards to a calendar spread that I have put on. It's gone down quite a bit in value. It's on Caterpillar. It's October, November 90.
Yep.
When I purchased it, the stock was at about 86, and I guess my question relates to the theta of the trade. Calendars are positive theta trades, yet when I look at my position, I notice my theta is negative $9.40. Is that because it's gotten so far out of the money, or?
That's exactly right. So that's a great question, Steve. So and I'm going to visualize this here for everyone out there. And so you said it was an Oct-Nov calendar spread, correct?
Yes.
Okay, so I'll just visualize this for everyone out there. But, from a calendar spread perspective, if we really look at where your break-evens might lie, and for everyone kind of looking at what we have on the screen, not obviously going to look exactly like your position because we don't have the exact cost basis here. But, from a calendar perspective, you have your break-evens, right? You have your break-evens in this calendar, your theoretical break-evens, because volatility is going to have a big part in where essentially those break-evens are going to lie, and we can't really predict what volatility might do into that calendar. But once we really get outside of that range, essentially you need a move in either direction to bring you to a point in that position where it will be profitable, right? So if I'm outside of my break-evens and we just sit there, every day that goes by is taking money out of my pocket because I'm not in a profitable area of the trade. And this kind of goes for, even an iron condor, or even a short vertical spread. Those are all positive theta trades as long as you're within your break evens on expiration. Otherwise, what happens is essentially every day that goes by is another day that you're not in the profitable area of your trade and another day closer to ending that trade as a loser. So if you just think of it from a winning and losing perspective, if you're within those break-evens where it would actually be a profitable trade, every day is technically going to help you because as those days erode, you're closer and closer to actually having those options expire in your favor and moving forward. But in this case, if you're outside, in this case, Caterpillar, you're outside of your break-evens. Every day that goes by is, it's hurting you because essentially as you get closer to expiration, you're locking in that potential loser. Does that make sense, Steve?
Yeah, it does, because my break-evens are somewhere around 82, and I'm well outside of those. I guess I let them go a little too long. The other question, maybe it's the same answer. What about volatility? Because I know rising volatility is supposed to help too, but I guess it can't overcome a price drop of that magnitude? Is that?
That's also a fantastic question, Steve. So from a short-term perspective, what does volatility essentially do to your potential break-evens in a calendar spread? If you have rising volatility, that essentially means that your potential break-even points in that calendar spread will widen out a little bit. So potentially that a calendar spread is a positive vega trade. So volatility will, in most cases, be beneficial to that calendar spread. And there's some instances where you can make the argument against that, but in a lot of cases, from a calendar perspective, you're going to have a positive vega trade. In other words, volatility is going to help that. So as volatility comes into the market, your break-evens might widen out a little bit and then potentially put you in a winning position and then have positive theta effect. So from a short-term perspective, you definitely could see a little bit of lift with increased volatility, given no movement at all, everything else equal. And I kind of, it's an economic term, and I hate that, all things else equal. But in this case, you just see a rise in implied volatility. Obviously, that's going to increase the price of your options. In the short term, for that short-term option, obviously that's not a beneficial thing because you're short that option. But that longer-term option is going to be a little bit more sensitive to increases in volatility. So as long as you're seeing that same level of increased vol, you would actually, that would be beneficial to that calendar spread. But Steve, to take this a step back and say, well, what are the cases where that might not be as beneficial, right? So if in a case like something like today, or maybe the VIX is a good example. I think the VIX is a really, really good example because you might have a short-term spike in volatility, right? You might have a short-term spike in volatility, but the market does not expect that spike to really be around over the long term. We expect some sort of recovery or return to normalcy, over, let's say, 60 to 90 days. So what you might see in some cases where volatility increases, you have that short-term volatility or the near-term volatility increasing, but the next near-term or those further out options are not increasing in volatility as much as the short-term. So that is a potential case where a rise in volatility can actually hurt you when you're in a calendar spread. Does that make sense, Steve?
Yeah, it sure does.
Yeah, because you're short that front month option, and if you have increased volatility, essentially it makes that option worth more, which is not in your best interest when you're short an option, right? You want that to decay and eventually go to zero, or as the least amount of value as possible before you exit. And on the long side, you're long something, you want it to increase in value. So if you don't have an exact or a proportional kind of move in volatility across the strikes that you're participating in with that calendar, you can potentially have negative effects with increases in volatility. So that's why I always hesitate when people think about calendars as a positive vega trade. I think for the most part that's a very safe assumption. But there are a lot of cases out there where you do have a short-term increase in volatility where that's not necessarily the case over the long term. So you brought up two excellent points there, Steve.
Okay, and then so I guess then with only 14 or 15 days left in this trade, there's probably a lot that I can do with that.
Well, I think what's interesting, and this always depends. So you bring up an interesting point on adjustments, right? You have that you're short the 90 oct call. I'm assuming this is a call calendar. It might be the put calendar. Yep. I'm assuming it's the call calendar, right? So you're short the 90 oct call, which is essentially, from a probability perspective, if I just look at probabilities, there's about a 1% chance that actually expires in the money. So, I mean, you don't have much risk on the table here, right?
Right.
What's interesting, though, about Caterpillar is the amount of vol really in these options, right? I mean, we have a 70% volatility. So what's interesting is while these 90s, you probably got almost everything you can out of the October 90s, right?
Yeah.
But I would ask, what in your opinion, you have to look at, okay, what else can I do to potentially manage this trade? Well, if you're so comfortable at the 90 area in November, and I'm just looking at the probabilities here, the 90 strike in November, again, an 8% probability of expiring in the money. So what can we do there? Well, if you're not comfortable around the area, if we've had essentially a level shift in Caterpillar, I mean, always you have to consider what your overlying or what your outcome is on that underlying, right? If we don't really anticipate a move to the $90 area in Caterpillar, well, is this a trade worth hanging on to, right, Steve? But right, on the other end of that, if I'm not necessarily anticipating a move to that level, well, what can I do to possibly repair it? And there are cheap ways to remain bullish in Caterpillar and possibly put on some sort of repair strategy. And I think diagonals are different ways to do that, obviously going long, deep in the money and starting to sell something a little bit out of the money. Like the 82 and a half, so I don't know what, from a probability standpoint, there's only a 19% chance that we actually touch that strike between now and November. And even at, even in the October, the 82.5 has only a 9% chance that we touch that strike between now and expiration, which is 17 days away. So at that point, it's, where can I bring in some premium here, given the high volatilities that we're seeing? Again, assuming you're still bullish. So there are definitely repair options out there in terms of diagonals and different things like that. But, I think when you get caught in this trade and the calendar spread and you see this type of level shift, you really do have to take or reevaluate what your expectations are in the underlying before you start saying, okay, what do I do with this trade? It's never a good option to say, okay, let me see how I can manage this trade, because you really have to level set here when you have this type of shift and say, okay, what's my expectation on the underlying given the probabilities and implied volatility that the market's giving me?
All right. Well, thank you very much.
Thanks, Steve. Great questions.
All right. Great answers, too. Thanks a lot.
Thank you.
Bye-bye.
So we've got, just as a quick update, I know we've got a ton of callers here today, and I appreciate everyone's patience as we get forward to it. I just want to give a quick market update again. The S&P 500 is still trading around the same area, 1094.75. We're up $8.50 on the day. The VIX is trading 43.66. We're down $1.79 on the day, but we did see a high of close to $46. Close to 47, so 46.88. And obviously a lot of news out there on Apple, so I wanted to give a quick update. Apple trading at $380.31, up $5.66. So what's interesting here is the last time we kind of looked at this, and it was 2 weeks ago that we took a look at Apple and that significant move that they had made to 422.86. And it's, we had seen this very, very high resistance level at the 400 area. And we saw a move above 400. Well, why did we see that significant move above 400? Well, if you look at that day, right? If we look at that day, sorry, I just kind of shifted the chart on you, but that was September 19th when we made a move. We opened at 397. Traded as high as 413, and we closed at 411. So a significant move from that 400 level, into significant penetration into the 400 level. If we look at September 19th, what did we also see right around then? Well, we saw on the 15th that RIM actually announced earnings, and needless to say, those were not satisfactory. I mean, we made a move from the 30 level to basically the $24 level. I mean, we gapped down about $5, and a $30 stock is a significant move. So we saw essentially their not market share, I should say, well, their earnings told us otherwise about the market share, but the market cap essentially took a very, very big hit, and I think Apple was a very big beneficiary on the wings of that news. I mean, we made a move. We were kind of uptrending into that area, but over the next 3, 4, 5 days, a significant penetration in the 400 level. But unfortunately, at that 422 level, we just were not able to sustain that buying activity. And we talked about this 2 weeks ago. We said, you know what, it's going to be a very, very difficult environment from a technical perspective because Apple's trading in places that we haven't seen before. So from a technical perspective, you're relying on historical information to give you some sort of roadmap on the future, and that's just not possible here with Apple. So Polar, and we've got the Tiger Den up. Everyone in the Tiger Den, feel free to type in as many questions as you can, and we'll be answering those as well. I appreciate it. Polar in the Tiger Den says it looks like Apple event will be all about software, iCloud, and voice commands. So it's very, very interesting. Obviously, we have the new iPhone that's going to be released. We have the new iOS, which is the operating system that will come alongside the new phone. We have this iCloud service here as well. So the question here is what do I do with this information? And if you kind of look at what Apple has done into these product launches in the past, just on a very, very short-term basis into these product launches in the past, it's kind of been one of those situations where you buy the rumor into the actual launch, and it's kind of, after the immediate launch, we do tend to see, or we have historically seen a little bit of a sell-off, but then, again, as the numbers start to come in, and I think each one of these products in the past, whether it be the iPad 2, there was questions on, is there enough in the iPad 2 to essentially overcome what you're seeing with the iPad? Was there enough enhancements? Is there enough marketing around the iPad 2 to convince buyers to upgrade or to go to that new product? And so not only did that happen, but we also saw additional penetration of the tablet market, additional adoption. So here at the 380 level, obviously you have an upside, from a technical analysis standpoint. We just made highs at 422. It told us buyers were unwilling to take us higher than the 420 level, and sellers kind of came in at that price as something they felt a little bit overpriced. We are now settling right around the 380 level. And from a range perspective, it's right in the middle between this 360 and 400 level. So just to take us into Apple and look at the implied volatilities, guys, we're seeing about a 54.5% implied volatility. And given the overall market, that's for October, right? That's 54.5%. If we look at November, a definite decrease in implied volatility, 5% decrease in implied volatility for November, which means October's a little bit expensive relative to November. So those noves are a little bit cheaper than October right now. And, if you're expecting, some of that implied volatility to come out of October with some of these product launches and even out with November, that could be an interesting opportunity. So I point that out to everyone, but obviously be cognizant of this move. And I think it's very difficult to pinpoint where they're going to be because, Apple in general, Polar, you kind of hit it on the dot. I don't think either long or short. It's a very difficult call here into these product launches. But again, that's not great advice. I know everyone wants to hear a little bit, one way or the other. But at a 380 level, if we're sitting here at 422 or 420, a little bit easier to call. But right here in the middle of this range into the product launches is going to be interesting. But from a volatility perspective and where the vol play is, you've got a little bit higher volatility in the Octobers than you have in the November. So there is some interesting opportunity there to play against those 2 months. So moving on here, so I think we've got a couple of callers who weren't able to get through. Go ahead and feel free, anyone out there. We want to address as many questions as possible here at 877-927-6648. Let's jump back into TBT, because I think this is, with everything that's in the news, everything that's, literally in the news with the Fed, continually coming out and issuing, signaling and things like that. I think it's so important that we understand the possible opportunities that are out there, right? So again, we mentioned before, a couple of weeks ago, I said, hey, we're going to sell $400 billion in short-term treasuries and buy longer-term treasuries, which essentially, if we look at what that does, essentially it's going to lower long-term rates, and the estimate is by about 0.2% is what that effectively is. So effectively, that's like lowering the Fed funds rate by 25 basis points, 250 basis points, so 0.25%. So in the overall scheme of things, why didn't we just move Fed funds? Well, essentially you have a target rate now of 0 to 0.25, so there's no effective room to kind of play with the Fed funds rate. So I think here the Fed's kind of getting very creative on fiscal policy and what they're able to do in order to potentially increase or ease monetary conditions, I should say. So they've effectively lowered long-term rates by 0.2%, which is why you saw this move in TBT from already sitting on the lows. Again, last time we spoke, which is about 2 weeks ago, we were sitting at the 22.5 level. And right now, or today, we've made new lows at $18. I mean, effectively, if you know what TBT is, and we talked about it before, but TBT is an ultra-short layman 20-year Treasury ETF, right? So if we look at what that is essentially doing, because it's an ultra-short, let's think about what the typical relationship is between yields and bond price. Bond prices are increasing, right? Yields are decreasing, and vice versa. So in this particular case, when you flip something, an ultra short, you're essentially saying this underlying product is going to move in the same direction as yields. So if our longer term yields, which this is tracking to 20-year Treasury, are effectively coming down, well, TBT is going to come down as well. So we mentioned this would be an interesting play into that last Fed meeting, and it turns out, from a bearish perspective, that was definitely, kind of the move here. And I think the writing was kind of on the wall from a certain perspective, as, a lot of the street knew effectively what that outcome would be, not necessarily the amount, but we did see that news come out and effectively moved yields. But the question is here, and I won't spend too much time, but I do think it's important we understand. I do think it's important we understand the economic climate. The question is whether or not this actually stimulates the economy, and it's out there. Whether you listen to CNBC, you listen to Bloomberg, Tiger Financial News, that's really the question, right? Does it stimulate the economy? Because essentially, or theoretically, you lower rates, well, it's going to stimulate longer-term lending. But is the problem that rates are too high right now? I don't know that that's necessarily the issue. I think and Nick in the Tiger Den says absolutely not. I mean, rates are very, very attractive at this level, and I think more people are questioning, is it really just a question of demand? At some point when you start to move down these rates at these attractive levels and you're not seeing the pickup in demand, well, is making them more, but it's always that balance, right? If you make something free, demand's going to pick up. You make something extremely cheap, demand's going to pick up. And I think that's kind of the idea behind it. But we're already at very, very attractive rates from a lending perspective. All right. Enough about the Fed. I love Nick is very, very active here in the Tiger Den about this, and I think it's been on all of our minds, it's all across the news, and in fact we might even be sick about listening to it from a certain perspective. But I think when we take a step back, when we really say, okay, they're feeding us all this stuff, what does it really mean? Let's break it down. And I think the trade here, right? We talked about it. What was the trade? And the trade was TBT, and we're continuing to look at TBT. I want to make another quick mention because last time or 2 weeks ago we talked about Intel, INTC. We talked about Intel. So Tiger Den, we post, hey, everyone, give us a question, 877-927-6648. And guys, if I don't get some callers, I will sing, and you don't want to hear that. From an Intel perspective, INTC, we're trading today at $21. And here's what's interesting. I'm not going to sit here and say we made some quick calls here, but 2 weeks ago we sat here and we looked at Intel and we said, hey, we've made some interesting bottoms in the chip makers, and particularly in Intel at 1950 and 19 levels. We made some great, I don't want to say some great lows. We made some definitive lows. I mean, we traded at that 19 level. We picked up. We retested the 19 level, and we picked up again. So we started to look at that and say, where do we think the potential is here? And we traded up to as high as 22. 22 and a half is I think where we were trading. And I think from a technical perspective at that point we said, you know what? This is essentially, from a technical perspective, if we just look at the chart, right, you were seeing somewhat of a declining trend. We were making lower highs. From a technical perspective, and I know, this is the options hour, but I think we're always mixing technicals with how do we take those technicals and play them from an option perspective. But from a technical perspective, we made about a high of $24 at the end of May. We made a high of around 23 and a quarter throughout June and July, and then subsequently we were trading up to about 22.75, and we said from a technical perspective that high we will run into resistance here at the 23 level, and we noted that the 22 and 21 puts were seeing some extreme volume. I want to say extreme, but I want to say abnormal volume versus the rest of the chain, and specifically the calls. So the put-call ratio was very interesting to us, and we moved off the 23 level extremely quickly. So we talked about where essentially the liquidity was from selling some of those potential call spreads. And, we made a very, very interesting move. So I just kind of put that out there to everyone, and I think it's important that we're always, if we're going to talk about underlying securities, we're going to talk about stocks. And I think Don always does this, right? He's kept you informed on what he's doing with with TBT trades, gold trades, and everything else. That when we talk about something, that we continually follow up and say, hey, how did that work out? Speaking of gold, obviously you can't talk about underlying securities, right, without mentioning gold, because it's really everywhere. And we made a move up to that 185 level. I'm talking, of course, of GLD, not quoting the futures contract. I'm talking, of course, of GLD, the Spider Gold Trust, which tracks gold. Really, it's essentially a portfolio of gold bullion, so it's going to track very closely to the actual futures contracts. We're trading 157.80, 157.79 today. We're down $3.16, which is essentially a 2% move on the downside. So obviously, when we saw, and I want to take everyone through a look of, intraday, the move that we've essentially had in gold. So when the entire market, right, when we're down to the 1068 low level, what was gold doing? Well, we were essentially staying relatively even. I mean, we really weren't moved too much off of that 160 level in the early part of the day, which is very, very interesting, right? It told us a little bit about the fear of the market. While we had VIX going to 48, we were noting that gold really was not seeing maybe the potential highs that you might expect. Which was, for us, very, very interesting. I mean, when you typically have this flight to quality in a market that sees a 30-point down day, and from a VIX perspective and people buying puts and increasing volatility, that was happening. Unfortunately, that same move was not happening in gold. So you're seeing a 2% move off in gold when you're only seeing about 0.5% or 0.75% move to the upside in the overall market. So interesting move there. I would encourage everyone out there to keep a look on it from a volume perspective. From a volume perspective here today, really not much to report. It's right on par with its 10-day average. So for everyone that's kind of interested in watching, I should say, volume. Obviously, gold right on par. Apple is about 2% above their 10-day average right here from volume perspective. And Netflix we talked about, obviously, as well with their move. And what's interesting here in Netflix particularly is we have a very large decline in volume from what we've seen over the last 10 days. I mean, we're essentially trading 50% below volume averages for this time in the day. So typically you would see around this time, which is 11:38 Central, that we would be trading about 50% higher volume than we actually have today. So really, really light volume there in the Netflix trade. So I point that out for all of you out there from an underlying perspective. We're not talking about option contracts. From an underlying perspective, that's kind of where we're at. So I want to talk about something that's really, really related, I think, more closely related to options than anything else. So what I've essentially looked at here today is we saw a spike in implied volatility to the 47 level. With that, what other underlying securities are demonstrating high implied volatility? Because I don't think it matters too much from an options trader perspective. I mean, if we're buying or selling options, what's interesting is what's going to give us some movement here in the short term. I think for a lot of us. Others of us are maybe looking for neutral plays, but implied volatility gives you, it does give you the opportunity to play that underlying security is going to stay within a defined range regardless of implied volatility or not. So I'm bringing up Bank of America. Bank of America has finally kind of moved below that $6 level, and I think it's a very interesting play here. I think it's kind of a dangerous play, to be quite honest. We finally broke down through the $6 level with conviction yesterday. And so what I've noted through that move, through the last 2 days, and you guys have probably seen it as well, is that implied volatility, if you look at what implied volatility is, what we're trading at this level is 144%, essentially, 143%. So essentially, what is implied volatility telling us? For all of you who, that term, it from an option perspective, but you don't necessarily know it, what it's telling you. Well, Bank of America is trading at, let's call it $5.50. So if something can move 150% in either direction, and again, that's not telling us which direction, essentially that's telling us that Bank of America could move $13, give or take, either way. Well, if I'm already trading at $5.50, can I move $13 to the downside? No, absolutely not. I can only move $5.50 to the downside. But essentially on the upside, given the implied volatility, you have the potential to add on $13, which would put it at about the 18.5 range. Essentially, that's what implied volatility is telling you. So if we look at really what the opportunity there is, when we're looking at Bank of America, from a call side perspective, vol is telling you that essentially you could potentially make a move up to 18.5 level. Well, is that essentially something we are going to see? Well, maybe not. But from a probability perspective, if we start to factor in what the market is giving you 45 days in Nov, essentially you're getting a little bit of bang. If you were to go in and sell, let's say the 4-strike puts, you're getting 35 cents on those underlying on the underlying options. So 35 cents at $4. You're basically your return on risk for doing something like that is about 10%. And annually, if we essentially look at that from an annual basis, right, your return on capital is 36%. So it's an interesting move from a risk to reward perspective. I think obviously it's a speculative play with where we are in Bank of America, but we were noting essentially that all of these financial securities here today are demonstrating some rather high implied volatility. So Bank of America is just one, but Genworth Financial is another one out there, and from a volume perspective, this one isn't going to blow you away by any means. But interestingly enough, we're trading about 170% implied volatility. But again, essentially, you still have rather tight spreads, but the open interest in volume is difficult. So you can get in pretty easily, but I would encourage you, when it comes to expirations, one of the difficulties is going to come to actually get out of any of these underlying securities. One other one that we noted here as well is MS Morgan Stanley, with a little bit more volume, obviously. Trading about $12.55 today. We're up about 9 cents. But from implied volatility standpoint, again, 160% implied volatility, which essentially means we take the numbers again, we flip that on its head. That's telling us a $40 move in some direction. Well, again, if you're trading at $12.50, can you make a $40 move to the downside? Absolutely not, but you could make a $40 move to the upside, which puts you, from an implied volatility standpoint, at essentially at $52. So looking at what's, the potential there, essentially that makes those 9 and 10 strike puts kind of expensive. And so if you look at, again, what your return on risk and return on capital is for those underlying, looking at that 10 and 9 strike puts, those are 12 to 14%. Again, in this type of environment, with the overall market, if you are going to take long positions, especially in financials, it's important to know what that risk is on the downside. And so what I've essentially done, or what we've done, is we've looked at the E-mini S&P, and we've said, where are essentially our support and resistance levels, our potential support levels from this kind of break that we've made here recently. And if you look at where we are, we're at 1095, but we touched 1070 exactly. And I think from that next level down below, we made a strong, strong rally. So a very, very bullish day at the 1070 level, which could, if we see some extension here, with this very, very bullish candle that we're making, if we see extension of this into the close of the day, it could mean, it would be a rather bullish end to this kind of downtrend that we've seen. But again, the trend is still to the downside. If we were to kind of look at what's happened over the last couple of weeks here, essentially we are again making lower highs. Every time we rally, we're essentially making lower highs. And I think it's interesting here. A very, very bullish candle. We do have a couple of callers here, so we're going to go ahead and take a call. That in mind, let's go ahead and talk to Ari from Arcadia, Florida, who has a question on RGLD. Ari, how are you?
I'm pretty well. I sold a call on RGLD.
Mm-hmm.
I sold January 2013 75.
Okay.
And I sold it at 18.17. So I'm in the money. And I originally envisioned the RGLD going down to 55 or maybe even 45. But somewhere between 55 to 45, I was going to have to do some kind of action with this coal.
Mm-hmm. So you said you sold,
now.
Right? You sold, and what strike was it? I'm sorry, I didn't catch you.
I sold 75 January 2013.
Gotcha. You sold the 75s. Gotcha.
And I sold it at 18.17. That's what I got.
Mm-hmm.
So there's a couple things I can do, and I'm sometime between 55 to 45. I'm going to have to do. I could just buy the stock to protect myself. So it's like I would buy the stock at $18 less than what I'm buying it. B, I can just cash it out.
Mm-hmm.
And C, I could roll it out and move it to 2014. And if I do that, I probably would lower the rollout. So I would take a lot of premium out of it using time decay. So, or there's something else that you may suggest that I would do.
All right, perfect. Thanks, Ari. So just to get on the same page, I want to make sure I heard you correctly, because we had a little bit of phone troubles here when you got on the line. So you sold the 75 RGLD January 13 call. Is that right?
That's correct.
Okay, and you sold it at about $18, a little over $18, and it's now trading about, let's call it $7.75.
That's correct.
And so your question is, if we reach the 70, or excuse me, your target here for RGLD is about 55 to the 50 area. And if we hit the 50 and 55 area, what are the potential ways to manage that position? Is that the question?
That is correct.
Perfect. Thank you very much, Ari. So it's interesting here. I think that you've chosen to sell something that's so far out as far as time is concerned. So I'm curious, Ari, when it comes to November, January, April, you had all these different series to choose from. Why did we select that January 13 option?
I got $18 premium front.
Right.
And I knew I was somehow going to manipulate that option. And the reason I sold it is I'm really thinking that I may buy the stock. I may actually buy the stock and keep it. And I would view it as I bought it at $18 less than the whatever price I pay. Gotcha.
Perfect. So I definitely see where you're going here, and I would for everyone out there, this is a very, very interesting strategy. So I think what Ari is saying essentially, just so we're on the same page, is that Ari was somewhat bullish on RGLD, but short-term bearish, long-term bullish. So essentially, he's looking for an entry point, and that entry point in his mind was about 50 or 55. So he said, you know what, where we're trading, and I'm assuming you're probably, if we just look at the chart here on RGLD, probably somewhere around $80, $75 when he made this decision. So selling the 75s would essentially allow him to bring in potentially $18 a premium, depending on where we went. But with so much time left in those options, it's hard to imagine that they would, essentially, be trading at next to nothing. So we had to know going into this, if we look at all these options, even the 120s, which are completely out of the money, are still worth about, $2. So we had to know going into this that if $55 to the downside was our expectation, these options would not be less than about $7 or $8 in value. So knowing that we probably, our maximum profit here was probably $10 to $11 in these underlying options. So Ari's saying that essentially, if he were able to pick up these shares at 55, he would have brought in $10 essentially from selling this call and essentially make his cost basis about $45. Now, it's a very interesting way to enter a position, and I would say if we looked at it on the opposite end, Ari, if we look at it on the opposite end, well, what are the 55 puts really worth, right? If we look at the 55 puts for January as well, they're about $10. So essentially what could happen here, and even if we go a little bit closer, let's say January of this year, if the 55 puts, get you $2.50. So if essentially we did trade down to that area, you would by default, pick up those shares. And what is the risk here? Well, if it goes to the upside, you're going to keep the premium in that particular trade. Whereas in this scenario that you've drawn out, where you're selling the call, well, in that particular case, the risk to the upside, even though you're long-term bullish, is that you don't actually get down to the 55 level. You recover somewhat quickly.
What strike month are you talking about when you're talking about the puts?
Yep, great question, Ari. So essentially today I'm talking about the January 13s because those are worth $10. But if I were to look at potentially the Aprils, which are a little bit closer, those are still worth $6. So all I'm saying, Ari, is that there's opportunities to sell puts and essentially generate the same amount of premium, and the risk there, if the stock goes up, you're essentially profiting regardless. So even though you're long-term bullish in the underlying, you've put on a position that in the short term could potentially lose money if the stock rallied before going down. But in this case, Ari, you were dead on, right? You sold the call, and now you're going to be very, you have the potential to be profitable and buy in that call. Essentially just buy in the call and go long the underlying stock. So I think from a strategy perspective, I don't see any problem with what you have set up, and clearly you're already $10 profitable. The one thing I would say from a margin perspective is that buying RGLD outright at $60, right? It's $61. From a margin perspective, is probably going to cost you $20 per share, about 30%, right?
Yeah.
What's interesting is utilizing some sort of stock replacement by utilizing a deep in the money call. So the reason I like to actually talk about this a little bit, and I'm just going to bring up, if you're watching the screencast, Ari, delta. So essentially, you could look at the Jan 12s, and you could say, what out there could give me a relatively high delta for less than potentially, $25 or something like that, which you end up going to hold on margin and then pay interest on. And so if you look at January the 12s, you have some interesting options here, like the 45 calls are in the money with an 85 delta. The 40 calls are in the money with about a 90 delta. So those are deep in the money calls that could potentially give you the same exposure, stock exposure, without utilizing the same amount of money from a margin perspective. So you can actually save yourself a little bit of money. So I put that out there, Ari, as a potential for you. Instead of going long the stock, you have the potential of limiting the risk, limiting the capital exposure as well with utilizing some sort of deep in the money call.
And that be a January 12th?
Yeah, January 12, those have high deltas. If you want, again, you're going to have options here. You could utilize the November. The problem with November is that the highest delta you could get is the 55 strike. So unless we request or someone requests to the OCC new strikes here, you've got about a 72 delta. Which, it's relatively high, but if you're expecting a move to 55, if we move to 55, the delta is only going to be 50. So, if you have something a little bit deeper in the money, which the Januaries provide to you, that one might be a more interesting option because a move to 55 still keeps your delta relatively high.
Let me ask you a little bit about buying something. I'll look at the January 40, okay?
Mm-hmm.
And on my machine, it's saying between 2080 and 2240. That's the spread.
Mm-hmm.
Where would you go in for buying that kind of range?
That's a great question, and we get that all the time here, Ari. So $20.80 is the bid, $22.40 is the offer. So the theoretical value of that particular option is $21.60. And if I know something's worth $21.60, I'm trying $21.60. If I don't get it, then in this particular case, we're probably trading in dimes here. Maybe I take off a dime. But what I typically do, or what we typically talk about when it comes to execution is, if I know I want to execute a 10 lot in this, maybe I only execute a 1 lot. I put in, I'm kind of fishing here. I put in a 1 lot at 2160, and I don't get filled. I keep the 1 lot and move it to 2150, and I get filled. That way I know there's a market there at 2150, and if that's something I'm willing to execute the rest of my 9, 10, 3, 5, whatever it is, then we'll follow up the rest. We'll follow up the rest at that particular price. But that's a little way of fishing in between those bid and offers to see where that real execution or where the real market is. Does that make sense, Ari?
Yes. One question about logic.
Sure.
Since I'm in a good position now, I might as well let it find the bottom. There's no hurry for me to get into the 40, is there?
Say that again?
Since I'm in the money now, and it looks like the downtrend is down, so the more down it goes, the more I'm in the money, then I'm better off waiting for when I would go into the 40 call.
Right. I think, Ari, it's dangerous when we talk about in the money here because when you say in the money, you're making money. The option itself is out of the money. So you've sold the call. It's an out of the money option and moving further out of the money, which is profitable in your perspective. So you're saying essentially, should I wait here and find the bottom? Well, if your downside price target is $50, well, essentially, if you were to close out that option right now, and enter in the long side of the market, your effective cost is $51. So from here, at this particular point, you do have some time here to really wait out the bottom of the market. But again, we did have a very, very bullish day. It just kind of depends on what you're playing. Is it a really short-term move, or is it a longer-term move here that you're trying to capture here, Ari? So it's a great question. We've got about 2 minutes left and a couple people on the line, but great question, Ari.
Thank you.
Thank you. So we've got Kevin in New Jersey. He has a question about spreads. Kevin, are you still on the line?
Yes, I am. How you doing?
Very good.
I wanted to ask you about doing calendar spreads. Don had talked about a lot when you have a high VIX.
Yep.
The VIX is at 43.69. My question is, if you're doing a calendar spread, say November with long call, and you're doing a long call, and you're selling the weekly October on the SPY. When the market goes back up, the VIX is going to get crushed, which means the value of your long call, say out in November, is going to contract. So you could actually lose money. True.
Yeah, so I think that's a really, really good question. And we talked a little bit about calendars before, and Kevin, I got to say you're right on target here. We've got a high VIX. If you were to go ahead and purchase a calendar spread, clearly that volatility is going to hurt you on the long end, but depending on where we're situated with volatility, and volatility is cheaper in the front month than it is in the long month, so I'd encourage you to be careful here. But it is a calendar is a long Vegas spread.
You're better off doing vertical.
You got it. Something that's actually short Vegas. Not a problem. Great question. And I think that's a good point. In a day like today where you have high volatility and you're expecting contraction of volatility, put on positions that are going to match that. So thanks, everyone, for joining. I had a great 1 hour. Hope you did, too, and we'll see you next time.
Great Basin Gold is a mining company engaged in the exploration and development of 2 emerging gold properties in Nevada and South Africa with a total resource base of more than 23 million gold ounces. Great Basin Burnstone Mine in South Africa opened in February of this year with a resource of 20 million gold ounces, becoming the first mine to open in the historic Whitwater